Welcome to Morningstar. I'm Larissa Fernand, and with me today is Vetri Subramaniam, the Chief Investment Officer at UTI Mutual Fund. This is part of a series where we look beyond the numbers at the mindset of seasoned investment managers. Vetri, let me start by saying thank you so much for your time and agreeing to be part of the series.
Delighted to be here, Larissa. Always a pleasure to have a conversation with you on the Morningstar platform.
Thank you. You recently put out a note where you said that in the world of investing, it's rather futile to attempt to predict the future. Instead, one should look for things that probably won't change in the next 10 years, such as self-sustaining businesses. So apply that to your mindset and tell me what has changed over the past 10 years and what has not changed.
Right. So, this is really my own lesson from history over time because, if I look at my career over the last 30 years and see the kind of sectors as they have sort of grown in size and scale, what increasingly becomes visible to me is that it's a function of which company is able to actually execute well and eventually benefit from that opportunity over time. And when I try to condense this down, it really becomes a question of, again, if I go back, 30 years ago, you could have said banking, there will be new companies that will emerge. Maybe 20 years ago, you could have said it was retailing. But when I look back at the companies which stumbled, right? So what we're looking at is who actually didn't manage to achieve their potential. Then what I find is that typically these were companies which, to use an old, Greek fable, essentially flew too close to the sun, right? They took too much risk. They sort of overemphasized the growth ambition, the growth possibilities. What they did not focus on was making sure that they were earning a healthy return on capital. What they did not focus on was, is the business generating cash on its own? And which is why, my belief over time has been shaped by the fact that there are many great, interesting business opportunities in India. But what really matters is how well you execute. And execution comes down essentially to those two parameters, return on capital and your ability to convert profits into cash. And just one other point I'll make over there, I mentioned, private banks in India, for example. Remember, the first bunch of these started somewhere, about 30 years ago. Mind you, most of those banks have actually fallen by the wayside. It was just one or two which eventually became successful. So, when you talk about execution, to my mind, it comes down to those two factors.
You mentioned about flying too close to the sun or falling by the wayside. Can you recollect a time when it happened to you when investing, and how did you mentally cope with it?
Sure. I think early in my career when, I used to sort of, it was possible for me to get swayed more by what, companies said and did, or how they focused on growth. And, I can point back 20 years ago to my conversation with two companies, both of which were sort of pioneering a retail business model in India. One was trying to do the apparel, groceries, provisions. Another company was doing only private label, apparel. And they both were completely different contrasts. One was being very conservative, very slow, said, we want to understand the model, we don't want too much risk. The other entrepreneur, always bubbling with energy, always looking for, there's a great opportunity, I've got to grow fast, I don't mind committing some mistakes, we'll correct them, we can always course correct. And when I look at what the outcomes have been 20 years later, that extremely, entrepreneur who told great stories is no longer around. The company has gone bankrupt, whereas the other company, which was always slow and steady, saying, we want to understand the business, we'll only scale when we are sure about it, has actually gone on to create significant wealth for shareholders. So, I would say that is one classic example to my mind. Just to be very clear, one was the Future Group, the other was Trent and Westside, and today the market has determined who's been more successful.
So is that why you focus more on hardcore financial numbers so that you maintain objectivity? You don't get swayed by the story of a narrative or the founder?
Absolutely. I think early on in my career, I would certainly plead guilty to getting carried away by the narrative. And therefore, I've actually done this for two reasons. One is that I find actually it's better to let data tell you the story. And what this means, Larissa, therefore, is that over time, I've actually gravitated away from companies which don't have a 3-year, 5-year, 10-year history that I can see. Because if I can't see it, I'm not able to build conviction in myself. So I've typically tended to stay away from IPOs because it's too short an interaction you get with the company. You barely have access to 3 years of data. So let the data tell you the story about the company. Studying that 10 years of history allows you to understand the company better. And equally important, Larissa, when you've studied that history in depth, you can actually question management better. But I've tended to stay away from managements, and I've tended to let my team do that. I'm not saying there's no value in meeting companies. Of course, there is value in meeting them, but I've preferred to say, I'm happy to get my questions from the data. I'm happy to let my team meet the companies, when it is required, and then sort of, bridge these two together in a way that it makes sense to me. But if I don't have the data, I'm happy to give the opportunity a pass.
Okay, so you have data, then you have your team meeting the management. Sometimes does gut feel come into any of these factors in the whole bigger scheme of things?
No, 100% it does. I think certainly gut feel plays a role, whether you're playing sport or whether you are in the investing world. Look, I think investing is eventually a combination of both science and art. Right now, the science is a function of the way you look at the fundamentals and all those different factors. You can also be disciplined about the science by using a simple tool as a checklist to make sure that you've looked at everything that needs to be looked. You haven't missed anything, and that's the most important part of a checklist. You haven't missed anything. But eventually, when it comes to pulling that trigger and taking a decision, there is obviously some level of gut feel involved. Now, what you try to do as a fund manager over time is learn to trust your gut instinct more and to sort of hone that gut instinct over time. But it would be foolish of me to say that there is no gut instinct in fund management. Certainly there is.
How do you manage expectations? You once said that investors need to learn to manage expectations. So you have to manage your own expectations, that of your team, that of your board. How do you play this game?
It's a challenge. And, I think the simple reason this is a challenge in an industry like ours is that we run open-ended funds, and anybody based on information available to them can invest in them, right? So there's not necessarily a one-on-one connect between the fund manager and the investor in terms of coming together, having a conversation, seeing that there is a matching of minds, and then, investing. So that is something we will always, is a challenge that we'll have to deal with. But of course, it's also what helps us grow our business in size and scale. Now, the most important part of this, therefore, Larissa, becomes few things. One, you need to and should articulate your portfolio, investment process and your philosophy very, very clearly. Make sure that data related to this is available to the public. So you not only tell people what you will do, you also give them the data that allows them to track that you are doing and executing exactly what you said you would. Two other elements that I will add to this, Larissa. A lot of people in fund management always talk about where they will invest. I think it's equally important for fund managers to articulate where they will not invest, right? Because that's what really then can give somebody comfort that this person has, certain boundaries within which they would be investing. The second thing that I think it makes sense for fund managers always to articulate to every stakeholder, be it the board, be it your investors, your own sales team, your distribution partners, what is the market circumstances under which your strategy is likely to perform well, and what are the market or economic conditions against which your strategy may not do as well. I think that requires a little bit of experience from fund managers as they go through their own cycle of performance and non-performance to understand what in market cycles can impact them, and then articulate that to the world. Simple point I'm making, Larissa, is if you can help shape the expectations, you can do a better job of then managing those expectations going ahead. But articulation is the simple way to sort of make sure that the world is already prepared and your stakeholders are prepared to understand what it means to be invested in your scheme.
As a money manager, what makes you insecure?
What gives me most discomfort at when I talk about a company level is in a sense where I don't have enough history, or the history is not throwing up a pattern, or at least I am not able to discern the pattern. And if I'm not able to discern the pattern, then that makes me quite uncomfortable. But otherwise, in terms of market phases, I don't face too much of a challenge when dealing with difficult markets with punishing news, because in a way, I find that stocks are now trading at valuations, and they fit into my valuation discipline a lot more. So I find it easy to act when the news is poor, but the valuations are giving me comfort. Where I really struggle is when the news flow seems to be, excellent, exuberant, but the valuations are not giving me comfort. So I'm always a little bit more unsettled when things are going extremely well, as opposed to when the markets are proving to be a lot more challenging. I'm a lot more at home in a challenging market than I am in a market which is sort of running away every day.
Can you name me one cognitive bias? Everybody has their own biases. Now, it could be either that they are reluctant to let go of a loss, or they give too much attention to a buy decision, not enough to a sell. Can you name me one thing that you have tackled over the years that and has worked to your benefit eventually?
When I started my career, I was a lot more focused on what we call errors of commission, right? Which is, I was a lot more worried about buying the wrong business and suffering a capital drawdown. But as I've invested over time, what I've come to realize is that in equities, the payoff is asymmetric, right? Very simply speaking, if you put 100 rupees in a company, you can lose only 100. But if you put 100 rupees in a company, the upside can be 2x, 3x, 4x, 5x, 10x. So the symmetry is more to the upside than it is to the downside. And therefore, what I've realized is that what has really troubled me in my career have been the errors of omission, either because I have not bought a good business because it did not come into my valuation discipline. That I can still live with. But what really has pained me more have been the errors of omission or commission, where I've let go of a great business way too early. And I've had, therefore, to rejig my thought process around, once you've identified a good company, how do you continue to ride it? And therefore, I, pretty midway through my career, reached this thought process of saying, it's very important to me that I buy a business at a valuation which gives me comfort, but I'm happy to own a business when it is doing well, even if the valuations get slightly overextended. However, I cannot ignore my risk. I can manage my risk by position sizing. I can manage my risk by looking at the position in relation to the aggregate portfolio and how it is positioned. So I would say this is really the behavioral bias that I had to overcome, where early on in my career, I was too worried about valuations. I let go of some of my best investment opportunities too early, and I had to build this parallel thought process, which caused, sometimes I think it's sort of made me schizophrenic, but I think all good investors have to be schizophrenic. When you make the investment, you want valuations to be in your comfort, but to get the benefit of those investments, you've got to learn to stay invested, even when those valuations give you a little bit of discomfort. So it's a little bit schizophrenic, but learning how to handle that schizophrenia, I think, is really what makes good investors.
Oh, lovely. Okay, and my last question is, you've always been a sort of a buy and hold guy. So do you think your mindset has changed now that the pace of disruption is so rapid, or is it again just a story that people give?
Right. So, Larissa, interestingly, when I started my career, I was actually on the prop book, right? So this was a proprietary investment book. And actually, we had, therefore, a fairly high frequency portfolio. We were, in fact, trading positions in the portfolio, some of them on a daily basis, some of them on a weekly basis. And then some of the positions, stayed there for much longer. But again, pretty quickly in life, I figured out that because of the asymmetric nature of the payoff in stocks, it actually made sense for you to think more longer term than to think short term, right? Because you want the benefit of that 3x, 5x, 10x, and you don't want to limit yourself to only making 10%, on a daily, weekly basis. Not that it's really possible, but, you don't want to limit your upside downside ratios to such a low skew. So, I had to readjust myself. And the second thing I realized is that once you're managing money at scale, what I was doing in the prop book was possible at that scale, which was very limited. It was a tiny sum of money. But if you want to sort of manage larger and larger sums of money, then you've got to deal with scale. And the minute you've got to deal with scale, you've got to think longer. You've got to think, how do I hold companies in my portfolio for longer? And how do I remove the impact cost of having to transact too frequently? So I think that's where over time I built up the sort of thought process that, I'd like to hold businesses for longer in my portfolio. Final point, I think we sort of uh, miss the large sweep of history when we talk about disruption. I'd say I've seen enough disruption in the last 30 years of my career, starting with liberalization to, an economy in which tariffs came crashing down, new business models have evolved. The future will always change, but the past was also changing. And therefore, if my toolkit could help me navigate the previous 30 years, I'm sure it'll help me navigate the next 30. There's one thing that you need to do to help you manage disruption, and that's the advantage I find of working with a team, which is that in a team, and particularly if you've got a team which has got a blend of experience and youth, it is the youth who will sometimes ask you those questions, which will cause you to perhaps reconsider preconceived notions, or for that matter, cynical opinions that you may have built up over time. So I tend to use people in my team, not just as a sounding board, but as people who will throw those uncomfortable questions to me, which may then cause me to have to rethink some of my beliefs, which could very well be related to the disruption that you were talking about.
You've always struck me as a very intellectual kind of guy, always. So I just want to ask you, does luck play any role in your thought process?
I'm very grateful for all the luck I've had, even in my career. Even to be here talking to you, Larissa, is a combination of luck. It's people who have wished me well at different points of my career. It's a function of just having been at the right place at the right time and having benefited from it in my own career. Now, if that be the case, how can I presume that luck doesn't play a role in anything that you do, including in investing? So I think certainly luck plays a role, and we should all acknowledge that, all the privilege, all the success that we've had, be it in our investing career or in our life and career itself, is all a function of some of those lucky breaks that we've picked up along the way. So, I'll just conclude with this one statement, which is, attributed to Napoleon, though it's debated. And I think Napoleon was looking to hire a general, not hire a general, but select a general to lead a particular military campaign. And then, all his sort of, maybe his team of analysts looked at all the data and told him, look, this is the guy who's the best suited general to lead this campaign. And Napoleon famously asked, but is he lucky? I don't think he was expecting an answer, but, I think luck certainly plays a role.
Thank you, Vetri. I've been very lucky to have interacted with you over the years. So thank you so much for your time today. I really appreciate it.
Thank you. Thank you so much, Larissa. Delighted to do this conversation, which has gone in a very different direction, but, hopefully investors will find it useful.
Cool. Thank you for watching. I'm Larissa Fernand.